Good afternoon and welcome everyone to your 2024 Regulatory Highlights Update from the Maryland Office of Financial Regulation. I am Tony White McCoy, Director of Outreach and Education, and I'll be your moderator today. So just a couple quick things before we get started. You'll notice at the top of your bar there is a box with a question mark. Please, if you didn't get a chance to enter a question prior to today's meeting, go ahead and ask your question in the question and answer section. Also at the top, you'll see the piece of paper with the paper clip. We've placed some materials there for you, including a copy of the presentation, as well as bios of all the speakers and some other information. Now, you may be wondering if this is going to be recorded. It is. But until the end of the meeting, we won't be sure if we can get that information over to you. But don't worry, if you have additional questions, we'll have your email contact and we'll be able to answer them directly to you. Now, if you have any technical questions, please use the chat. My colleague Cynthia is manning the chat, so if you have any technical questions or concerns, please ask away to her. Again, welcome to your 2024 Regulatory Highlights with the Maryland Office of Financial Regulation. And with that, we'll go ahead and get started.
All right.
I'm going to ask one of my colleagues, once I share the presentation and have it up, Tony, if you can just make sure that you see the presentation okay?
There we go. I see it with the sidebar.
Okay, give me a second here from beginning. A little difficult and challenging, but that's okay. We'll get it up.
Absolutely.
All right. And without further ado, please, I'd like to introduce you to our commissioner, Tony Salazar. Tony?
All right. Thank you, Tony. Appreciate that introduction. We're good to go. Good afternoon, everyone, and welcome. I'm pleased to say that this is our 4th annual Highlights webinar, and I want to thank each and every one of you who are joining us today. We're trying a new format this year, and I trust that you'll find the session informative. Our goal is to highlight information that we believe you need to know and to provide guidance to industry and consumers on trends in some of the areas that are of interest to our office. Events such as these and our quarterly meetings with consumer advocates are part of our office's commitment to staying connected to you, the constituent. Bear in mind, however, that OFR has a broad mandate, so this session isn't going to cover all of the areas subject to our authority. Instead, it's designed to focus, as the title indicates, highlights. This year, joining me in the presentation will be our 2 new deputy commissioners. If you regularly follow our office, you'll know that the legislature authorized the creation of a deputy commissioner for the non-depository activities, and that commissioner would join the existing deputy who has the responsibility for our office's depository institutions. With that, I'm happy to introduce, and you'll hear from Mike Sprouse, who is a Maryland banking industry veteran and who's our depository deputy commissioner, and Kat Hyland, who is an experienced consumer attorney and former assistant attorney general, who is our non-depository deputy commissioner. You'll also hear from our assistant commissioners for financial services, licensing, and supervision, Sharifa Balagoon, who will provide information on important issues on the non-depository licensing and examination front. You'll hear from Meredith Merchant, who is our assistant commissioner for consumer and external affairs, and she'll speak about consumer complaints received by our office. Maybe you can see some trends and understand the issues we face. She'll talk about some outreach as well as foreclosure points. And you'll also hear from Assistant Commissioner Bob Yeager, who's our policy commissioner, and he'll touch on legislative matters in our office's student loan work. We're expecting to have a chock-full hour of information. On a staffing note, please check our website and social media accounts regularly for announcements of new personnel and the job openings that we might have, because our office is pretty much always seeking to fill one vacancy or another. Overall, I was pleased with our office's work in the last year. During this presentation, you'll hear a bit about some of that work, as well as about our direction. Our presenters are going to talk about our office's actions on the climate front, news about our work on Governor Moore's Innovative Access to Banking Act, some legislative information and successes, including the passage of HB 686, which simplifies licensing for our non-banking constituents. Kat Highland will tell you about new enforcement priorities and some actions that we've taken, including discussion, and Bob will talk about the consumer complaint trends and student loan front. So, our mission is to protect Marylanders through the operation of a modern financial regulatory system that promotes respect for consumers, safety and compliance, fair competition, responsible business innovation, and what we all want is a strong Maryland. We've laid out 5 goals that align with Governor Moore's priorities. First and most important is protecting Maryland consumers from financial harm and educating them about their financial decisions. We want to modernize continually the financial regulatory system so it's efficient and effective. We want to provide an equitable and inclusive financial system that leaves no Marylander behind and fosters broad participation by all in our economy. Can't forget our employees. We want to enhance their engagement and empower them to execute with excellence. And then, very important as well, is strengthening our collaboration with our sister state regulators, with other Maryland agencies, and as well with our federal counterparts. So as you'll see, we've been working diligently towards those goals. Fiscal year 25, which starts in a few short weeks, we'll be tweaking some of them, but of course, we're going to remain faithful to our mission of providing consumer protection and striving to modernize the state's financial system, as I mentioned above. Finally, I want to recognize the hard work not only of today's presenters and of our supporting staff, but also of all of OFR's staff. Licensing, supervision, enforcement, these are all hard jobs. And our staff are working diligently every day to make sure that Maryland consumers can transact their financial business safely and that the financial ecosystem is healthy and fair. We regularly produce annual reports, with our most recent one being issued at the start of this year. That report and the report produced by our Student Loan Ombudsman are available on our website in the About Us section. So you should check those out because they'll give you a good history as to where we were in the past year, and they provide a lot of data as well. So thank you for joining us today. I hope you find that today's session is engaging and informative. And with that, I'll turn it over to Assistant Commissioner Bob Yeager to start the session. Take care.
Thanks, Tony. Good afternoon, everyone. I'm Bob Yeager, Assistant Commissioner for Policy, and I'll be sharing some updates on legislation and regulations. In the 2024 session of the Maryland General Assembly, OFR proposed 4 departmental bills, all of which would impact financial services. HB 246 deals with earned wage access. 247 addresses issues related to foreclosure. 250 creates third-party exam authority, and 254 is our true lender bill. Each proposed bill addresses issues that are important to Maryland consumers and the Office of Financial Regulation, and I'll discuss each one briefly. HB 246 relates to EWA. Earned wage access products are both popular and helpful for a number of consumers, but they can be costly, and as they are generally offered today, it's likely they fail to comply with Maryland law because they're considered loans. The General Assembly ultimately did not pass our EWA bill last session because the legislators were unable to bridge the gap between the industry's and consumer advocates' positions. OFR is continuing to develop additional insights into the use of these products in Maryland, and we will continue to be active on this topic. In HB 254, our true lender bill, OFR sought to confirm current laws to address the problem of high-cost out-of-state lenders attempting to enter the state. This bill would have established a clear framework for industry to follow if they sought to partner with out-of-state banks to bring high-cost loans to Maryland. OFR's Enforcement Division recently settled a case on this topic, and though the legislature decided to table this bill for next year, or table the bill this year, OFR will continue to be vigilant and scrutinize bank fintech partnerships that seek to introduce high-cost products into Maryland. Foreclosures are an issue that's always of interest to OFR, and with HB 247, we introduced a bill that would have improved consumer protections in a number of ways. Most notably was the provisions on zombie mortgages, or foreclosures of mortgages for which no payments have been made in 5 years. The legislation required the servicer to provide periodic statements to the homeowner for at least 24 months prior to the foreclosure and restricted the interest the secured party could request to 3 years prior to the foreclosure sale. Though the bill was ultimately pulled for further refinement, the issues OFR identified continue to be of concern, particularly the zombie mortgage issue, which was highlighted in a recent NPR report. We are currently evaluating data to determine any appropriate legislative or regulatory response. Our final bill from last session, HB 250, did pass and was signed into law by the governor. The new law will authorize OFR to perform third-party exams on service providers for licensed or chartered entities. This authority was required for OFR to accept third-party exams performed by other states or federal agencies, and it was also required to participate in multi-state examinations. This new tool will enable OFR to operate more efficiently and to utilize its resources more effectively. OFR will also be supporting the governor's transparency initiative as we work to implement SB 472. Under the new law, OFR will provide cost and processing times for the license, charter, permit, registration, and examination processes performed by the office, in accordance with Labor Department protocols and direction. Other bills that passed that may impact financial services include HB 262, 622, and 567. The new law under HB 262 increases the minimum threshold for transactions that must be reported on a consumer's credit report. OFR will provide guidance to consumer reporting agencies and consumers about the impact on a consumer's report. You can always sign up for notices of issued guidance on our website at labor.maryland.gov/finance. Another new law under HB 622 prohibits consumer reporting agencies from including on a consumer's report either expunged criminal cases or criminal records that did not result in a guilty verdict or plea. Again, OFR will provide guidance to consumer reporting agencies and to consumers about the impact on a consumer's report. And finally, following the enactment of HB 567, the Maryland Online Data Privacy Act of 2024, OFR will monitor the Act's implementation and provide consumer guidance on its impact on consumer privacy. Again, you can subscribe to OFR's industry advisories, consumer guidance, and other important updates on our website. Now I have some updates on our recent regulations. This year, 2 new OFR regulations were finalized. First, our Money Transmission Regulation fully implements the Model Money Transmission Modernization Act. And our Mortgage Exam Regulation allows OFR to accept exams from other state and federal regulators. 2 more regulations are currently pending approval to appear for comment in the Register in the coming weeks. First, our Shared Appreciation Regulation provides guidance after the 2023 bill HB 1150, which covers shared appreciation mortgages, became law. Drafting for these regs was done in coordination with the state of Connecticut, which has a similar law. And finally, our Branch Licensing Elimination Regulation provides clarification and guidance for OFR's assessment authority following the enactment of the 2023 bill HB 686, which eliminated branch licensing for financial services providers in Maryland. Now I'll pass it over to Mike Sprouse, OFR's Deputy Commissioner for Depository Activities, who's going to talk about what's happening in our depository unit. Mike?
Thanks, Bob. Good afternoon, everyone. I appreciate this opportunity to share some information on depository risk. The national and local economy continues to provide challenges to all consumers and businesses of our state. Inflation has caused an increased cost in every commodity that is essential to everyday life, such as food, energy, and housing. The Federal Reserve's tightening of monetary policy has made strides towards the target rate of 2%, but inflation continues to be an issue. The fight to control inflation, along with other economic factors, has presented our financial institutions with management challenges, such as higher interest rates for longer than expected, inverted yield curves, higher cost of funding, declining deposit base, compressing net interest margins, and borrowers facing increased financial pressure. Despite these challenges, most of our state-chartered financial institutions have been resilient in supporting our local communities by providing financial products and services that enhance the economy of our state. The financial institutions have managed the balance sheet to provide stability and confidence. However, senior management needs to manage current and future risk in an ever-changing dynamic economy. I will discuss the following risks: liquidity risk, commercial real estate credit risk, cybersecurity risk, third-party relationship risk, and climate change risk. So our first topic is liquidity risk. In the wake of the failure of SVB and Signature Bank in the spring of 2023, liquidity took over the spotlight as a major concern for all regulators and financial institutions. The balance sheets of some institutions were not prepared for a higher for longer interest rates, as well as the deposit runoff that occurred because of a chase for yield by consumers and businesses after a long, low-rate environment. Deposits migrated from the regional and community banks to larger national institutions that provided higher rates on certificates of deposits and money market accounts. Decline in deposits forced financial institutions to reprice at higher interest rates, causing pressure on cost of funds and interest expense. This change in the balance sheet structure also caused many financial institutions to increase their liquidity lines of credit and other high-cost borrowings to manage funding needs. Community banks increased the use of higher-priced wholesale funding, such as broker deposits, as another liquidity source. Appropriate liquidity management starts with a planned framework that includes funding sources and uses specific to the institution. All the liquidity tools and best practices need to be implemented and managed appropriately. The FDIC revised its liquidity and funds management examination policy to address the heightened concern of liquidity management. Please see the attached link to this policy along with the Federal Reserve Bank and NCUA's liquidity risk resources. These policies provide detailed information on liquidity management. Some suggested liquidity management concepts for review are to have a liquidity plan that's diversified and not be concentrated on one solution in order to provide the institution with options. Ensure your institutions have access to liquidity lines of credit, such as the Federal Home Loan Bank, Federal Reserve discount window, or other correspondent lines of credit with other institutions. Liquidity plans should focus on immediate access to funds. Be aware of potential changes with the Federal Home Loan Bank funding. The philosophy of just having acceptable collateral for advances has changed to having acceptable collateral and the ability to repay the advance. They are not lenders of last resort. The stigma around the discount window is changing. This type of funding supports bank liquidity by acting as a safety net to weather disruptions in liquidity markets and access to other resources. Collateral for these liquidity lines should be pre-positioned to ensure access when needed. Understand deposit behavior and be aware of any concentration of deposits that could elevate risk. Track and monitor uninsured deposits exposure. Wholesale funding can be a liquidity resource in a liquidity plan. The institution needs to monitor this type of funding using prudent liquidity management concepts along with acceptable concentration. Make sure all liquidity software systems and reports are correct. Test and review. And finally, review all FDIC, Federal Reserve Bank, and NCUA liquidity management resources. Our next topic is commercial real estate credit risk. Commercial real estate lending has long been a profitable opportunity for financial institutions. In fact, according to the FDIC 2024 risk review, CRE loans held by banks grew for the 43rd consecutive quarter in 2023. However, the changes in business patterns such as hybrid working and e-commerce, along with higher interest rates, have caused an increase in credit risk in this type of lending. Most commercial real estate markets were acceptable in 2023, but markets for office and retail malls were weak. Therefore, it's not a surprise that the overall loan quality showed a weakness in office properties. As these types of commercial loans mature, it becomes more difficult to qualify the borrower to refinance the debt due to higher interest rates, low debt service coverages, lower property values, and other emerging credit weaknesses. The exposure of this type of lending is concentrated more in the banking sector, but credit unions are increasingly getting involved in commercial lending due to increased profitability. According to the FDIC 2024 risk review, the risk exposure could potentially get worse as $1.6 trillion in CRE loans mature between 2024 and 2026. These maturities will present challenges to institutions due to deterioration in credit quality. There are many strategies to help manage asset quality, such as having a strong credit culture with thorough annual reviews, updated financials, and current appraisals of collateral. Perform timely loan reviews, internal and external. Problem loans need to be detected early. Ensure loans are appropriately risk rated. Review all reports and systems for accuracy. Senior management and the board need to make timely decisions based on accurate information. Manage commercial real estate loan concentration per the bank or credit union policy. Overexposure to any type of commercial loan could increase risk. Watch office space construction loans. What would be the occupancy rate? A thorough understanding of this concept needs to be reviewed in loan underwriting. And finally, the board, special assets, and/or credit committees need to be active to work through problem loans. Our next topic is cybersecurity risk. Cybersecurity continues to be a significant risk to our financial institutions. The advancements of technology to deliver products and services has provided an opportunity to serve consumers and businesses with quick and efficient access. However, the bad actors who want to expose these technologies for personal gain have improved their sophistication and skills. Cybercrime continues to happen at record levels. A few areas of cybercrime concerns are malicious cybercrime activities continue to be more sophisticated. Ransomware and third-party supply chain attacks continue to threaten the financial industry. Geopolitical events continue to increase the likelihood of an attack from foreign nations. Even though the use of checks has decreased, check fraud continues to rise through the use of advanced tech by criminals. And generative AI can pose new risks to critical infrastructure systems. As these risks continue to evolve, it is paramount that our financial institutions utilize all resources that are available to mitigate these risks. Many strategies are included in an effective cybersecurity plan. A few of those strategies are to have an effective cybersecurity risk management and mitigation principles, the use of multi-factor authentication, strong systems configurations, timely patch management, effective third-party risk management, active audit and testing programs, perform tabletop exercises, maintain up-to-date business continuity plans, have ongoing training for staff and board, because almost 3/4 of breaches involve the human element, and review the FDIC, Federal Reserve Bank, and NCUA cybersecurity resources. Our next risk topic is third-party risk management. Financial institutions constantly strive to increase the value of products and services to their customers and members. Institutions are relying on third parties to perform these functions to compete due to financial and human capital restrictions. Third-party relationships can offer access to new technology, risk management tools, and new delivery channels that open the door to new products, services, and markets. However, engaging a third party does not diminish or remove the bank's responsibility to act in a safe and sound manner to comply with applicable legal and regulatory requirements, including consumer protection laws and regulations, just as if the bank were to perform the service or activity itself. Therefore, there are a variety of risks associated with third parties. This risk needs to be understood and managed appropriately. An organization can be exposed to adverse impacts, including substantial financial loss and operational disruption. Therefore, an organization needs to identify, assess, monitor, and control risks related to third-party relationships. As the use of third-party vendor grows, so does the risk. In May of 2024, the Federal Reserve, FDIC, and OCC released Third-Party Risk Management, a guide for community banks. The issuance of this document, along with the NCUA best practices evaluating third-party relationships, shows the importance of this issue. Although there are many factors in third-party management, some strategies are to review critical third-party relationships that could cause a banking organization to face a significant risk of the third party failing to meet expectations, having significant customer member impact, or having a significant impact on the organization's financial condition or operation. Evaluate and consider how to manage risk before entering into a third-party relationship. Conduct due diligence on third parties before selecting and entering into a third-party relationship. Negotiate contract provisions that will facilitate effective risk management and oversight and specify the expectations and obligations of both the organization and the third party. Perform ongoing monitoring of the third-party vendor. Understand how the third-party vendor utilizes other third-party vendors to support their products and services provided to the financial institution. Third-party governance needs to include oversight and accountability, independent reviews, and proper documentation and reporting. And finally, review all Federal Reserve, FDIC, and NCUA guides, best practices involving the use of third parties. Our final risk topic is climate change risk. Changing climate conditions in our nation can present challenges to individual financial institutions along with the larger financial system framework. According to the FDIC 2024 risk review, our nation has experienced the highest number of billion-dollar climate events on record for a single year since 1980. Although the state of Maryland may not have the elevated climate change risk as other states, it is important to understand the risk and have a plan in place to mitigate them. Our office officially started the discussion on this issue with our state chartered institutions during a webinar in 2023. The Office of Financial Regulation wanted senior management and the board of directors to discuss the effects of climate change and the physical and transition risks to their institution. In early 2024, OFR initiated a climate change questionnaire as part of the safety and soundness examinations. The goal of the questionnaire is to gain an understanding of how each institution is responding to potential risks caused by climate change. Later in 2024, OFR will present a second webinar on climate change as a follow-up to our first webinar. Okay, switching gears from the risk discussion, I will discuss an exciting initiative of our office, the Access to Banking Act. The Office of Financial Regulation implemented its first phase of the Access to Banking Act this year by awarding assessment fee credits to incentivize Maryland chartered banks and credit unions to open new and maintain existing branches in low to moderate income communities. Based on the application submitted by our institution, OFR awarded over $225,000 in assessment fee credits to 11 different Maryland banks and credit unions that operate 40 branches in low to moderate income communities in Maryland. These qualified institutions have over $3.7 million in deposits in LMI communities. It's also important to point out that 3 institutions donated over $9,000 of their assessment fee credit to the Maryland Community Investment Venture Fund. The second phase of the act is to establish the Maryland Community Investment Venture Fund to help Maryland banks and credit unions partner with fintech and innovators to better reach underserved communities through the application of products and services that promote financial empowerment, access to credit, and wealth creation. The standing up of the fund project is nearing completion. The fund's operational principles have been approved, and the advisory board that will guide the fund's strategic trajectory is currently being assembled. The Office of Financial Regulation plans to have the advisory board selected and convened for its first meeting by late summer 2024. Once the advisory board holds its first meeting and provides its initial recommendations covering the fund's priorities going forward, the Office of Financial Regulation will have some more information to share, including a future webinar later in 2024 about this exciting rollout of this initiative. So thank you. And now I would like to introduce our next speaker, Sharifa Balgoon, our Assistant Commissioner of Financial Services, Licensing, and Supervision.
Thank you, Commissioner Sprouse, and thank you all. Welcome to today's presentation. During today's presentation, I will highlight some supervisory observations and some violations that are frequently cited by our mortgage examination team, as well as our money service business examination team. I will also discuss some licensing observations and some common deficiencies found by our licensing analysts. I will also discuss some regulatory updates applicable to our financial service providers. And lastly, I will go over some industry resources that OFR has developed to support you in your compliance needs and obligations. Starting with our mortgage examinations and what our examiners are finding in the course of their examination. In recent examinations of our mortgage licensees, our examiners have cited an increased lack of responsiveness from our licensees. Maryland law requires licensees to maintain their books and records, and then make those records available to the commissioner for inspection and examination purposes upon request. Maryland regulation requires licensees to respond to a written request from the commissioner within 10 business days of the request. In recent examinations, examiners are finding that licensees fail to respond to our requests, or they're not responding on time. And what does this look like? Usually, before an examination or at the start of an examination, our licensees will issue an information request to our licensees and ask that documents are produced within 30 days. We're finding that licensees are not acknowledging the request, are not responding timely, or if they do respond, it's not a full production of documents. And this prevents us from completing our examination on time. It's creating delays in our examination process. In the case of mortgage brokers specifically, we're finding that brokers' delay in their response to us is because they don't actually have possession of the document because they're being maintained by the lenders that they work with. In response to our findings, examiners have directed brokers to maintain their records, even if they're just copies because the original is with the lenders. This is in compliance with Maryland law and regulation. Additionally, licensees who fail to respond to our requests have been referred to our enforcement unit for additional investigation, which can lead to an enforcement action. As a result of this growing concern, our examiners will be enforcing our authority in this space more strictly moving forward. Our mortgage examiners are also finding deficiencies with our brokers' compliance with our laws regarding finder's fee. Maryland law requires brokers to disclose finder's fees in the broker agreements with consumers. The law requires that the the finder fee be disclosed as a specific dollar amount. In recent examinations, our examiners are finding that licensees are not disclosing this as a specific dollar amount and instead are disclosing this as a range. Sometimes brokers are not disclosing the fee at all in the agreement. In response to this finding, licensees have been directed to cease the practice of disclosing brokers' fees, finders' fees, as a range. They've also been directed to implement revisions to their policies and procedures to ensure compliance with our laws and regulations. Additionally, if a finder fee is disclosed as a range or is not disclosed at all, licensees have been ordered to make refunds to consumers, and OFR has imposed civil penalties where appropriate. Now, moving on to examinations conducted by our money service businesses team and some violations that they're finding through the course of examinations. In recent exams of MSBs, examiners found deficiencies with the licensee's compliance with our notice and disclosure requirements. Maryland law requires notices to be posted by both licensees and their authorized delegates. Authorized delegates are required to post a notice at each location open to the public. The notice should include a statement that OFR will accept consumer complaints or concerns, as well as advise consumers of the NMLS Consumer Access website, where consumers can verify the status of a licensee. Licensees are required to include certain information on their website, social media pages, mobile app, and outside of a self-service kiosk. The information must include the licensee's unique identifier, a link to the NMLS Consumer Access website, as well as a notice stating that OFR will accept questions or complaints from Maryland residents, providing the address of OFR as well as our toll-free phone number. In response to licensees' failure to comply with the law, licensees have been directed to establish policies and procedures to ensure not only their compliance, but compliance from their authorized delegates. Policies and procedures should include controls for licensees to monitor compliance from authorized delegates, such as reviewing notices and the postage of the authorized delegates when they're onboarding a new authorized delegate, as well as conducting periodic on-site visits of their authorized delegates to make sure that they are complying with our notice requirements. Our MSB examiners are also finding deficiencies with MSB call reports. Maryland law requires MSBs to submit a call report once every quarter. The call report should be submitted through NMLS, and the report must comply with certain NMLS requirements around content, form, and date. Recent examinations have found that licensees fail to submit the call report, or the call report is submitted timely or is missing information. There has been some licensees that have expressed a mistaken belief that a report is not required where transactions were not conducted in Maryland in that quarter. Maryland law still requires a submission of a call report even when transactions were not conducted in that quarter. In this instance, licensees should just indicate 0 transactions. Now, moving on to our licensing observation and highlighting some deficiencies found by our licensing analysts. Our analysts are finding that our mortgage loan originators are not complying with continuing education requirements. Maryland law requires MLOs to complete 8 hours of continuing education prior to submitting an application for renewing their license. Analysts report that MLOs are not completing their CE prior to applying. If an MLO attempts to submit an application for renewal without completing their 8 hours, that application will be rejected. It will not even be accepted by the system. And if an MLO does not submit their application by December 31st with evidence that they've completed their continuing education requirements, that application status or the license status will be automatically converted to terminated, expired, and an MLO will be required to submit a brand new application, and not a brand new application for renewal, but a new application as if they were applying for a licensure for the first time. Our director of licensing, Arlene Williams, developed an instructional video for MLOs and their compliance obligations, which also addresses continuing education. And we have included a link to that instructional video to the spot on the slides. Another issue that our licensing analysts are finding is an increase of unlicensed activity, specifically with collection agencies. Maryland law requires collection agencies to be licensed unless they are otherwise exempt. Our law has a broad definition of collection agency and generally defines it as a person collecting on a consumer claim. A consumer claim is a claim for an amount owed or said to be owed, and this does not have to be a delinquent amount. This can be current or delinquent. The reliance on delinquent amounts seems to be a common misconception. A collection agency can include an attorney, homeowner association, debt buyers, debt collectors collecting on behalf of medical agencies or doctor's offices, or other persons collecting on a consumer claim. Our licensing unit is finding an increased occurrence of unlicensed collection activity, and this is usually coming in the form of companies self-reporting in connection with a license application. We're seeing cases of companies coming forward, submitting an application for a license after engaging in collection activity for 10 years, sometimes more. In fiscal year 2024, OFR has assessed over $600,000 in civil penalties due to unlicensed activity. And of that $600,000, over $500,000 has been assessed for unlicensed collection activity. Now, I would like to discuss some regulatory updates applicable to our financial service providers, i.e. our non-depository institutions. Two laws specifically that I'd like to address are the Shared Appreciation Law and the elimination of branch licensing. My colleague, Assistant Commissioner Bob Yeager, went over these broadly in his presentation, but the next couple of slides will go over some additional details. Starting with Shared Appreciation Agreement. Our new law, which was enacted July 1st, 2023, affirms OFR's position that shared appreciation agreements are loans and they must be licensed unless there's an exemption that applies. Generally, the law includes shared appreciation agreement in the definition of loan. The law defines what a shared appreciation agreement is. The law also subjects shared appreciation agreements to our disclosure, licensing, and general lending law requirements. The new law also authorizes the commissioner to issue implementing regulations. OFR is expected to issue a proposed rule in the coming week. Moving on to the next law, involving the elimination of branch licensing. This new law, also enacted on July 1, 2023, makes significant changes to Maryland's law governing the licensure of financial service providers. Generally, under the law, a license is required for a business activity and covers all locations or branches where a licensee conducts business, as long as those locations were previously disclosed to OFR. Generally, the law eliminates the requirement to have a license for each branch, and so there's no need to pay for a license for each branch. The new law requires disclosure of all locations other than the principal executive office where business is conducted, and this submission must happen through NMLS. OFR created a form and published this form on our website to be used by licensees to include the list of locations. The new law also authorizes the commissioner to issue implementing regulations. Regulations and a proposal will be expected to come out this summer. And lastly, to address the lost revenue from the elimination of licenses, the new law also authorizes the commissioner to impose an annual assessment on licensees. The factors to be considered when establishing the assessment amount is the cost of supervising that license category, the type and volume of business conducted by that licensee, as well as the assets of the licensee. Now, the next couple of slides will talk about some industry resources that we have developed to help with your compliance needs. On this slide, we have a list of industry advisories, including regulatory notices, guidance, and alerts. This can help licensees stay current with regulatory developments and provide guidance on current and emerging risks, as well as consumer protection topics. At this time, I would like to encourage you all to subscribe to our alerts so that you can receive information about our resources as they are published on the website. Tony, do you mind going back to the slide before? Thank you. The first guidance that I would like to, the next slide on the industry resources. Yes, thank you. The first guidance that I would like to bring your attention to is the one involving the enforcement actions by Maryland AG. On June 22nd, 2023, OFR issued guidance which highlighted actions taken by the Maryland AG as well as other states against cryptocurrency companies. Essentially, the enforcement actions alleged that the products offered by these cryptocurrency companies constituted securities and required a registration. Some of the companies subject to the enforcement actions are licensed money transmitters. Our guidance warned about the impact of the licensing status as a result of the enforcement action. And while OFR does not have the authority to enforce security law, we do assess character and fitness of our licensees. OFR needs to be confident that the licensee will conduct business in a lawful way, and a violation of any law, including Maryland security law, can impact that determination. A violation of law can subject the licensee to regulatory action, including action to revoke a license. There are a few more advisories and alerts listed on the slide, but the next slide talks about additional resources that we've made available for industry, including the disclosure document that we created in connection with the elimination of branch licensee disclosure law. Licensees can use this form to list the additional locations where they're doing business. We also have a list of mortgage lender FAQs, mortgage loan originator FAQs, as well as the instructional video that I mentioned in previous slides for MLO's compliance. We have licensing checklists for each license category and a separate checklist for new applications, amendments, and surrenders. We also have a list of all applicable laws, rules, and regulations. Currently, I am OFR's FinTech Innovation Contact, a role and responsibility that I am extremely passionate about. But secondly, this is an opportunity for you to engage with our office. The FinTech Innovation Contact is meant to assist entrepreneurs, FinTech officials, and new companies navigate the licensing process, review their business concepts, and go over generally the rules and regulations applicable to a financial service. We receive emails and phone calls on a consistent basis, and we are always happy to speak to someone about the laws that they may need to comply with in order to do business here in Maryland. So if you need that information, we encourage you to go on our website, again, as well to subscribe to receive our alerts. That completes my presentation. And at this time, I will hand it off to Deputy Commissioner Kat Hyland for Financial Services and Protection.
Thank you, Sharifa. So over here, I will be discussing our enforcement activities. OFR strives to maintain robust enforcement efforts. So to that end, we're strengthening our training on broad statutory enforcement tools, using our broad statutory power and expanding our in-house knowledge. So first, we've been working on issuing broader and clearer subpoenas. We will be seeking more court enforcement against businesses who fail to answer these as well. We're focusing on training topics and in particular increasing certifications for our fraud examiners, keep their knowledge current. We're also collaborating with other state and federal agencies by revamping our information sharing agreements so that we can more efficiently investigate pressing issues and explore trends. Finally, we're improving data capture to measure and report on our efforts annually to keep everybody informed. For end of year reporting. That's next slide. Okay. As for our outcomes, enforcement has been busy. So for calendar year 2024, public actions have resulted in approximately $622,000 in restitution, penalties, and administrative fees combined. This number includes $135,000 in penalties and over $212,000 in consumer restitution. An important component of many of the enforcement actions we work on also relates to licensing. As Sharifa mentioned, issues are often escalated from licensing enforcement reviews over to the enforcement unit. And so as you hopefully peruse through some of the examples that are listed here, you will see that often a business is held to come into compliance with licensing under certain statutes, from credit service businesses to collection agency licensing. And sometimes the outcome of an enforcement action will impact the business's ability to continue to do work in Maryland under the license that has been issued. And sometimes a result of an enforcement action or a compromise with the business may cause a forfeiture of that license. Here are a few noteworthy public enforcement actions that were released in 2024. These examples are from cases that have involved mortgage lending, collection agency licensing, consumer lending, and mortgage assistant relief services. I also encourage you to look at the actions from the end of 2023 as they fall into our fiscal year as well, and there are many interesting decisions to review. Now, a note for settlement agreements: when you're looking at a case and wondering whether or not it may apply to what you're working on in your particular business or industry, please consider that certain agreements may reflect a compromise or be case or fact specific. In other words, you shouldn't take them as binding authority to inform business decisions, at least not without reaching out and discussing anything that may be of concern. So we hope to be available here. Please contact me or anyone else with a question about whether or not something that your business is observing in the market, it falls into compliance or falls under our regulatory powers. Also consider that in some of the decisions posted, we evaluate statutory factors when assessing penalties. So some of the outcomes can be unique to the businesses and their enforcement agreement. Finally, you can read about past and present actions on the 2024 enforcement results page, and the link is posted here. And from that link, you can also access prior years if there's another decision or a type of business concern that you're looking to see if we've addressed. Finally, I want to draw your attention to some exciting strategic priorities. We've updated our strategic priorities by evaluating our goals from last year and incorporating new ones. Central to our enforcement goals is the idea of making sure that we're bringing cases and investigations that affect a significant number of Marylanders. We want to do the most work we can with the resources that we have. Next, we're continuing to investigate bank and fintech partnerships that may violate Maryland usury laws. In addition, we remain attuned to evaluating enforcement opportunities related to fair lending practices, and we're excited about how we've expanded our data tools to do that. The enforcement unit is also interested in looking at past agreements, and we're currently implementing different types of monitoring systems and formulating metrics to ensure compliance and make sure that there are no repeat offenders in the industry, and that someone who has agreed with something in the past continues to hold true to those agreements to be licensed and so on. Further, we think it's important that the public know and industry know about the outcome of enforcement actions. So we're striving to post these decisions to our website as quickly as possible and to be available to address any concerns about their impacts or advise on impacts when possible. A specific area that we're working on currently is improving our escalation process for complaints related to our power to enforce foreclosure regulations and trends in the foreclosure industry. We strive to respond to industry questions as well as consumer complaints. And to that end, I just wanted to mention that we understand that this past April of 2024, the appellate court came out with a decision in a case called the Estate of H. Gregory Brown versus Carrie Ward et al. And I'm mentioning this to provide an assurance that we are currently working with our attorneys general to evaluate the case's potential impacts and to be able to answer any questions that we may receive. Finally, we are involved in state and federal conversations on trending topics such as auto lending and student loan servicing. And if there is a particular issue that is affecting your work, your areas of concern, or your industry, we would love to hear about that as well. With that, I will turn this over to Meredith Merchant, our Assistant Commissioner of Consumer and External Affairs. Thank you.
Thanks, Kat. So we are running a few minutes behind, so I'm going to fly through a few of these slides. Please be aware that these slides are available for download in the materials section of your screen. So if you click on the paper that has the paperclip, then you'll be able to download a PDF of these slides. So first, the Consumer Services Unit receives and investigates complaints submitted to our office from consumers. The complaint can be about a licensed, registered, or chartered institution or individual, an entity that is conducting activity regulated by the office, or to report an unlicensed provider. Our investigations have the goal of resolving the immediate issue for the consumer, but issues of harm to the general public are also considered when determining an outcome. As a reminder, CSU cannot provide legal advice to consumers, nor can we override or dispute the decision of the court during foreclosure actions or collection. The insights and information gleaned from complaints is used to monitor industry trends and identify potential red flags, particularly for those industry categories that are regulated by OFR but not subject to our examination authority. If you're unsure as to whether the subject of your complaint is under the jurisdiction of our office, please reach out to CSU before submitting your complaint at csu.complaints@maryland.gov. Next, I'm going to go over some data on closed complaints by CSU. Please keep in mind that data is tracked and reported by the state's fiscal year, which is July through June. And really the overriding story from this slide is that we're just seeing a slight decrease of complaints from over previous years. On the next slide shows a little bit more about the different types of products that we receive complaints about. Non-jurisdictional complaints continue to be one of the top submissions. So we're working on upgrading our complaint submission system, our complaint form, and our messaging to consumers to help filter out complaints that are not OFR's jurisdiction. That said, when we do receive a non-jurisdictional complaint, we will forward it to the appropriate state or federal agency. I'd also like to point out a slight increase in debt-related and consumer loan complaints. So on the next slide, breaks down complaints by outcome. So also keep in mind when our examiners are closing a complaint, they can only select one outcome. The no action merited refers to if the respondent company didn't have to, if we, OFR, didn't have to require them to take an action. So this usually means that there was no violation, but it doesn't necessarily mean that the consumer wasn't helped. A company may voluntarily take an action through the course of the investigation that doesn't resolve the issue in the way the consumer requested, but they may still see some sort of non-monetary benefit, like maybe not removing a negative account on their credit report, but updating some of the notes in the report. The non-jurisdictional other slice of this pie is a complaint that's not for a federal regulatory agency or for an other Maryland state agency. And then corrective action is when CSU requires the respondent company to take an action to correct deficiency or something that was the cause of the complaint. If this action includes a monetary recovery, then it's coded as a monetary recovery and not a corrective action. So far this year, CSU has recovered over $80,000 in monetary recoveries for consumers. The next slide talks about CFPB complaint data. As the state financial regulator, OFR has access to the CFPB complaint database for those complaints submitted by Maryland residents. The next slide talks about or shows a comparison between the type of product that the complaint is about. So on the next slide, you can see that generally the pattern of Maryland submitted complaints follows that of the CFPB, where the vast majority of complaints submitted to the CFPB is about credit reporting, and that's only increased over the last few years. Next, I'm going to touch briefly on outreach and education. The primary goal of OFR's outreach is to make sure consumers in Maryland are aware of our office, who we regulate, when and how to submit a complaint, and what their rights are under state or federal law with respect to the industries we regulate. Outreach is also targeted at regulated industries to help improve compliance and understanding of laws and regs, in addition to establishing reciprocal communication channels. We also engage various consumer, industry, and government stakeholder groups to promote engagement with OFR leadership and to amplify our messaging to consumers and industry. Since the start of the fiscal year, the Outreach Unit has participated in 43 events, and just since March has had 1,376 interactions with consumers and stakeholders. And that is in very large part to our new Director of Outreach and Education, Tony White-McCoy, who joined OFR in January and is also the MC for this webinar. To that end, if you are interested in partnering with us on an event, or if you have a suggestion for training, please contact Tony. Her contact info is at the end of this presentation and in the bio materials, in the materials section of the webinar. We do a lot of our outreach through partnerships, so please don't hesitate to reach out to her. Next fiscal year, we'll be increasing our use of data to guide outreach strategy and measure outcomes, enhance our digital communications, updating and modernizing consumer education materials and industry training resources, and of course, continuing to grow our network of partners. Now we're going to switch gears and I'm going to share some totals from the foreclosure registration system. This graph shows the number of notices of intent to foreclose submitted to OFR through the electronic reporting system by calendar year going back to 2012. So notices of intent to foreclose, or NOIs, are mailed by the secured party or servicer after default to the mortgage borrower. It's a warning that they've defaulted on their loan and a foreclosure action may be filed in court. In April of 2020, the NOI reporting system was closed through an executive order to halt foreclosure starts during the COVID-19 pandemic. and the system was reopened in July of 2021. So that's why you see that dip over those 2 years. The number of NOIs has steadily increased since then, and we're about back to pre-pandemic levels. The next slide compares the number of NOIs with two other types of foreclosure registrations that are statutorily mandated to be submitted to OFR. The notice of foreclosure is a registration that foreclosing parties must submit to OFR within 7 days after the foreclosure action is filed in court. And that is the rusty orange reddish bar that you see there. The foreclosed property registration must be submitted to OFR by a foreclosure sale purchaser within 30 days after the auction date. And that's the green bar there that you see on your screen. So these three notices or registrations represent the three different stages of the foreclosure process: default, filing, and sale. This graph shows the totals by month since July 2021, which is when the system reopened after Maryland's foreclosure moratorium. So you can see that the number of NOIs or defaults per month is much higher than the number of foreclosure filings, which in turn is also higher than the number of actual foreclosure sales. So next, we'll take a look at the distribution of NOIs across the state. This map shows the number of NOIs received by OFR in calendar year 2023 at the zip code level. The darker the blue, the more NOIs. Please note that these are just the raw numbers of the total number of NOIs per zip code. So this map doesn't take into account the population or number of households in each zip code. We would expect to see more NOIs in the zip codes that have a higher density. This pattern that we see here reveals high numbers of NOIs in Prince George's County and the Baltimore area zip codes, which is consistent with previous analyses. But we've also started to notice hotspots in Charles County that have started to pop up in the last year or so, as well as some clusters in some of the more rural areas of the state. So what are we doing with this information? On the next slide, it talks a little bit about our use of the data. So we use the data from the foreclosure registration system for outreach, policy, and supervision. We mail resource letters to every borrower that receives an NOI. These mailings also include the Mortgage Late Don't Wait fact sheet, which is available for download in the materials section on the right of your screen. We also post the numbers of the three types of foreclosure notices on our website and on the Maryland Open Data Portal. And on the Open Data Portal, NOI data is aggregated by zip code and at the census tract levels. We're exploring new methods to better utilize NOI data by mapping addresses and analyzing the relationships with loan level and demographic data in the various communities. Our Director of Trend Analysis and Reporting, Brendan Armbruster, has been working hard over the past year to learn the ins and outs of GIS mapping, HMDA data analysis, and other tools. And we're excited about the possibilities and what we may learn from more in-depth analyses like this. One final note to those parties or entities that are required to be submitting notices or registrations through the foreclosure registration system: do not submit duplicates without confirming your records first. As you can see, we use this data in a number of very important ways, and while we can clean it, it's best that you don't submit duplicates from the very beginning. We issued regulatory guidance about this last month, and a link to this guidance is in one of the previous slides that was presented by Sharifa. So I'll go ahead and wrap it up here. Thank you, everyone. Now I'll hand it over to Bob Yeager, who's going to provide some updates on student loans.
Thanks, Meredith. Another important division in OFR's policy unit is the Student Loan Ombudsman. This position was established in 2018 and was created to provide student loan borrowers with a state-level office that can assist with complaints against student loan servicers. Working with OFR staff, the Ombudsman provides information about student loan processes and works with borrowers and their loan servicers to correct mistakes and facilitate solutions to problems. The Ombudsman also gathers information about the status of student loan servicing in Maryland to inform the public and lawmakers, and if necessary, make referrals for enforcement action where warranted. To subscribe to student loan updates and advisories, including notice of when the Student Loan Ombudsman's annual report is posted online, please visit our website. Now for some updates and activities in the Ombudsman's office this year. First, I'm very pleased to share that Amy Hennon is officially the new Student Loan Ombudsman. Amy has done a great job over the past several months as acting Ombudsman, and we're very pleased that she's now officially in the role. In other highlights, the office recently sent emails and letters to approximately 35,000 student loan borrowers with either federal family education loans, Perkins, or health education assistance loans to inform them of upcoming federal deadlines to consolidate their loans and to maximize their benefit from incoming-driven repayment account adjustment and loan forgiveness. The recently updated current deadline to apply for a loan consolidation is June 30th, 2024. If you take a look at the next slide, of those 35,000 borrowers the Ombudsman contacted, this map shows the borrower population based on census tract with FFEL program loans, the most common student loan type. The blue shows borrowers with an average student loan balance of under $20,000, and the red shows borrowers with an average loan balance of over $20,000. The darker the color, the denser the population with FFEL program loans. Based on the office's outreach, the Ombudsman has assisted approximately 1,000 borrowers with their student loans. Next slide, please. This year, the Ombudsman also published new information and assistance materials on public service loan forgiveness. This effort was the result of an agreement with lawmakers who sought to enact a statutory requirement in both 2023 and 24, and the office created and published these resources despite the bills not passing. Also this year, the Ombudsman has worked with OFR's outreach team to give several community presentations on public service loan forgiveness and the income-driven repayment account adjustment, which is scheduled to take effect later this summer. The office has also implemented the new law enacted in 2023 under HB 913, which defines student financing companies and requires them to register with OFR and submit data about Maryland student borrower activity each year. The office also maintains regular contact with other state student loan ombudsmen across the country to maintain awareness of developments and to share information and ideas. Finally, the Ombudsman stays engaged with the U.S. Department of Education on developments regarding FFEL loan consolidations and account transfers, returns to repayment, and public service loan forgiveness challenges. We're very proud of the work the office does to assist student borrowers and to inform policy improvements. Thanks for your attention, and now I'll pass it over to Tony White-McCoy, our Director of Outreach and Education, for our Q&A. Tony?
So thank you so much, Bob. Thank you to all of the amazing panelists today. We hope that we were able to give you some insight into who we are and what it is that we do here at the Office of Financial Regulation. With that said, I'm going to ask all of the panelists to join us once again. Welcome back, team. Thank you once again for all of the information that it is that you shared. I know we're running a bit behind, but I would like us to at least get to some of the questions that were submitted in advance. In the event you have a question, please put it in the question and answer section at the top. You'll see it there with the little comment box and the question mark. Although we won't have time to get to it today, we do have your email information, and we'll make sure that somebody follows up with you later. So the first question goes to Bob. Bob, what are your top legislative priorities for the next session? And is there anything the industry can do between now and then to assist? You're muted.
Sorry about that. So currently we are evaluating our legislative priorities for next year's session. This process will certainly involve collaboration with the industries. And we look forward to working with you to gain insight into potential impacts and to share our concerns. So definitely interested in having those discussions.
Thank you. Sharifa, please confirm that secured parties, trustees no longer need to provide info to borrowers regarding the Maryland HAF program.
Thank you. Information regarding HAF does not need to be shared with borrowers. HAF ended on September 18th. As of that date, all funds have been fully exhausted. Applications are no longer being accepted. However, servicers are encouraged to still provide all other available and relevant eligible loss mitigation programs to homeowners.
Thank you, Sharifa. Kat, can we please go over the upcoming assessment and how it will be calculated? Will there be a fee per transaction or a range?
Well, this assessment relates to the information on Sharifa's slides about the branch licensing law change and the Commissioner's non-depository special fund, the obligation to make sure we have sufficient funds in there. At this current time, you should first look at the industry advisory, also linked, about how there's no assessment for calendar year 2024. We anticipate issuing notices in April of each year, 30 days before the due date. As to the specific methodology, we are working very hard on the exact calculation of the assessment. I can't report on any more details at this time, but this is something we're touching every week in this office, and our goal is to roll it out as soon as possible. We really want industry to know how to prepare for the assessment. So as soon as it's finalized, hopefully within the next few months, we will get that information right out to you.
Awesome. Thank you so much, Kat. And the last pre-submitted question goes to Meredith. Concerning vehicle financing, are you seeing any trending issues or challenges with pre and post repossession notices?
Thanks, Tony, and thanks to the asker of this question. So in the consumer complaints unit, we're actually not seeing any major issues with the repossession notices. Most are sending them within the required, most lenders or financing companies are sending them within the 10 or 5-day notice period. We are seeing like a slight increase in auto financing and repossession complaints generally. And I think that follows a trend of consumers taking out high interest auto loans. We've also seen lots of repossessions of vehicles that were in accidents. And just as in with most of the depository industries, we're seeing third-party companies or third-party vendors that are coming in between the consumer and the financing company, or in between the consumer financing company and towing company, and investigating complaints and resolve.
Well, thank you, Meredith. I know we are running out of time. Do we have the time to take any questions that are in the question and answer section, or will we have our team members reach out to those individuals directly, Meredith?
I think, so we have 1, 2, 3. Yeah, I think it's best now to just reach out to them individually. We'll be able, we have your names and email addresses. So your question will be assigned to the right commissioner, and we'll get you within the next few days.
Thank you, Meredith. Thank you to all the panelists. Thank you to you, our stakeholders, and the community that we serve. We appreciate you taking the time out of your busy schedule today. We hope we were able to excite you about the hard work that OFR is up to with this 2024 Regulatory Highlights Update. And Tony, any final words?
I want to echo your sentiments there. Thank everybody. Hope you found this interesting and informative. And if you have any questions to follow up, our leadership team is here on the screen. Feel free to reach out to the particular commissioner that you need to speak to. We look to be open and available to folks. And thank you so much. Tony, take it away.
Thank you. Thank you, Tony, Meredith, Kat, Bob, Mike, Sharifa, and Cynthia, who's working hard behind the scenes. Thank you all so much. Have a wonderful day, and we'll see you soon.